So hello, welcome everybody. Today we have a great speaker, Boris Mann, who's come in today. Boris is from CodeCore, as you can see here, and he's the managing partner, right, and the founder of CodeCore. So they work with early stage technology startups, and they work with them, and then they also fund them. Well, I mean, depends, right? I'll work with them to find out, right? So, and then here is, you guys have come to CodeCore Bootcamp. So this is a 9-week bootcamp course for Ruby on Rails. If anybody has any questions or would like some more information, they can speak with Tam here and the CodeCore shirt after the class. So, yeah, welcome. Thank you.
Thanks. So the topic of this is something that I actually get asked a lot. So I ended up, as I usually do, when I get asked a question more than once, I have the programmer do not repeat yourself, so I turn it into a presentation. I call it a learning session. There's a lot in here. A lot of this is actually contrary to a lot of my other slides. I tend to read a lot of stuff off because it's actually good to just take on your own and go through it. But it's hard to go through some of these concepts, and there's a lot of questions. So feel free to ask questions as we go. If I'm going to cover it in like the next slide, I'll say, I got the answer to that coming up. Otherwise, let's have the discussion. And so go ahead and just put your hand up if you have a question along the way. So I have this thing called cap table learning session. So how about we start with what the hell is a cap table? There's a lot of lingo in new company formation and in startups around sort of some of the legal and accounting aspects. Because investors and legal and accounting professionals deal with hundreds of these things all the time, so they're familiar with all of these terms. As a first-time founder, you're encountering it for the first time. You are not alone. So it basically records the major shareholders of the company and also various things that you buy and sell shares over time. Those are all listed in there. You need one right away, is the answer. It is literally the document that talks about who owns what pieces of your company. There's also things like share certificates and other things like that. Your lawyer keeps sort of an official version. What you want to do is you want to have a version in Excel or through an online tool that you can do these sort of what ifs with. What if I sold 10% of the company? What if I brought someone in and rewarded them with some equity stock as well as some salary? And what would that look like? This is a question I get asked a lot as well. And I'm kind of not going to answer it. There's a tool right there that is interesting to look at for the types of questions that get asked there. It walks you through sort of a questionnaire of a multi-person team and then might give you some ideas. Ultimately, this is a very human, a very personal thing that you need to sit down with your co-founders and have a real discussion about sooner rather than later. One version kind of says, split everything 50-50 or equally amongst all founders. And that's actually a pretty decent way to start to think about it, right? Unless there's already an acknowledgement that someone is more junior or other things like that. And then if someone is, for instance, giving up market rate salary, or if someone is half-time and another person is full-time, then you might adjust how much estate that someone has. So reverse vesting. Basically what this means, when you create a company, you create founding shares, the initial share structure of the company, however you're going to split it, let's say 50-50 for starters. And however, what if one of the founders only sticks around for 6 months? They own 50% of the company. Like, what are you going to do? That is something that you should talk about ahead of time. So the mechanism of reverse vesting, you can't, as a founder, your founder shares are granted when the company is formed for a very small value, right? So you might have 1.5 million shares, but they're worth 0.0000, however many zeros to get them, make the math work, 1, so that you're paying $15 for those shares. So you own them. The reverse vesting is a standard piece of a shareholders agreement that describes how you get to keep or give them back over time. Pretty typical is something like a 1 year, and again, there's lots of jargon. It's okay, ask questions, but it'll give you a start for Googling some of this stuff too. A 1 year cliff and 3 year vesting. So what that means is, 1 year cliff, meaning, okay, if any of us leave before a year is up, we give all of our shares back, right? And everybody goes, well, I'm not planning on leaving, so I have no problem signing this. But you still have it written down just in case something happens. And then in a year, in my 3-year scenario, you would immediately get 30% of your shares. And then they would vest monthly, right? So that's typically how that works. When your company is actually valued at a later date, what you do is you give out options, and they are granted over time, so they vest. So for founders, because you fully own them, it's called reverse vesting. So just a little terminology there. Does anyone have any questions about that concept of vesting, cliffs, and other stuff like that?
They were saying after a year you get like 30%.
Yes.
But you don't get it right away. You get invested over time.
Exactly. Technically, you, as founders, you own them, but you have a document, a business document, a contract that basically says, if I leave before a year is up, the company gets all of my shares back in the pool.
How about if you leave like 2 years?
You can do however you like. A 2-year cliff is really wouldn't be fair, right? You know, it takes a while to get started and get up and running and say, hey, we're going to put a solid year in it. But you can make these factors whatever you want. That's for you and your founding team to sit down around. Even if someone leaves after a year, the company, and remember, there's a difference between the founding team and the company. Usually when you're started, you think of it as the same thing. It's actually separate, right? This is an agreement really with the company. So even if you leave before a year's up, contractually, you get 0, right? The company and the people in it might decide, you're like, you know what, contractually we have to give you 0, but how about we give you 5% for thanking you for starting up, right? But at least you know that ahead of time, and you have a basis to discuss, rather than having this big, like, oh, I did this, and I thought you'd be dead if it was. It's like, did we write it down?
Wait, so what about, let's say there's 3 people that co-found this company.
Yep.
And they all own 33%.
Yes.
So if one of them leaves before a year,
Yes.
other 2 automatically get 50% each, or they still get the 33%, while the remaining 33% goes to the company?
It depends. Technically, the company would own those 33% because it's actually not percentage, it's shares underneath. Let's say it's 100,000 shares. Let's say they split 300,000 shares, 100K each, right? So that 100K would be owned by the company. Generally, you would keep it owned by the company because the reason that you were compensating a founder because you needed them to do some sort of work for the company. So you might need that to attract another person with a similar skill set, right? And again, there's this difference between the individual and the company. Does that make sense? Okay. And we can come back to it. Ask more questions, please do. Here's a fun little phrase. Equity is like shit. Keep it piled in one place and it stinks. Spread it around and good things grow. So I wrote an article also about advisors. So I differentiate pretty clearly. There's lots of people that might be mentors who help out, give you some advice, you chat with every once in a while, that you might give a bottle of scotch to or something else like that. An official advisor is someone who's signed an advisory agreement and usually has an agreement also about vesting of shares of equity of your company. It's typically very, very small, like 0.25% to 0.5% is fairly typical for advisors, and even that would be over sort of a 3-year period. Something really high for an advisor might be like 2%. But then they're maybe on like a sales call with you and like helping to close deals or something like that.
Is there anything else in the advisor fee typically?
I have a link to a sample one on my site, and basically it acknowledges, you want to acknowledge what the person is doing for you. Are they helping you look for leads? Are they giving you feedback on your marketing plan? Like, it's a contract saying, this is what you're doing. Some people might actually even say, we're going to meet in person 3 times a month.
Okay, so it's obligations.
Yeah, absolutely. Yeah, two-way, right? This is equity. This is in lieu of cash, right? Advisory agreements might also have cash included too.
Quick question.
Yes.
Are you going to get to explain options in more detail in later slides?
I'm not. The short answer to options basically is once your company is valued, and typically options is something, and so this would be past an initial round of fundraising, then for staff, you might be handing out options. And the reason you give out options, and I'm not going to dive super deep into options, is those shares are actually worth something. So you're giving an employee, you can't just grant employee shares because it would be the equivalent of handing them, let's say $100,000, which is a taxable benefit. So even though your company is only worth something on paper, they would actually have to pay taxes on the full $100,000. So options is a way to basically say, you're allowed to buy stock in the future at a massive discount that gets around the tax issue.
Right.
Does that answer your question?
Mm-hmm.
Okay, perfect. My point about the cap table is most companies are not venture fundable companies. But you can use equity for staff and for investment. And you want to think about how much of my company do I want to give up, do I want to sell at each stage? Do I still have a significant portion? Does it make sense? And who can I, entice to join my team? And roughly at each stage of financing, the typical today for digital companies, digital startups, is about 20 to 30% dilution at each stage. Dipping a little bit into what do you do with it? Do you sell shares for investment? Okay. Man. So this is my simplified document to actually walk you through a little bit and help you understand shares and percentages. We talk about percentages because that's how humans can understand it, and that's what you need to know the percentages so that you can understand even in context what it means. Fairly typically, when a company is formed, it issues a very large number of shares. So in this example, I'm using 10 million shares. And you don't have to give them out right away. This is basically just authorized, saying the company, without having to go back to the board of directors, is authorizing up to 10 million shares to just be issued as needed. And then for founders, what we've done is we've actually said, okay, we're going to issue 5 million and hand those out and chop those up to understand the ownership of the company, right? So I've got founder 1, founder 2, founder 3. Founder 3 is a little more junior, so he has a little less. The 2 other co-founders have an equal amount. And this is just obviously the math that works out. Given 5 million shares to get to 40%, that's 2 million shares, right? Again, 100%, 5 million. Time passes, and you decide to, and does that make sense? Yeah, go ahead.
So there is still 5 million shares
Authorized,
authorized.
not issued.
Yes.
It's a minor detail, but like this, I could have just done 5 million and 5 million and
But
used
that's
them
there
all
so
up.
that you can,
It means that you don't have to do, there's one step of legal paperwork that you skip. Should you do, for instance, a financing and need to issue some more shares.
right.
Before we get too far, like, so remember, every single corporation, whether VC or federal, has this underneath it. So if you've done anything other than a sole proprietorship and actually incorporated, then you have shares and have this sort of thing. Right? If it's just you, then you own 100% of the shares. You may have done something very simple, right? But you all have this. This isn't some far off thing for other people. When and why to incorporate versus a sole proprietorship is another interesting discussion. There's a lot of tax benefits for the most part to incorporating, especially in BC. So this applies to all sorts of companies, not just some special startup thing. Okay. Now, we've decided that we need $300,000 in investment. And we have one investor that's going to write this check. Well, how the heck did I come up with this valuation? Any guesses? I made it up. But I made it up using a formula. Remember I said before that typically in each round you dilute by 20 to 30%? Well, if you add 300K to 1.2 million, you end up with 1.5 million, right? 300K divided by 1.5 million is 20%. I'll actually skip that percent there. I need to edit that. Per share, because that's the thing that I'm actually selling. I'm selling individual shares. There is no such thing as a fractional share. You would round up or round down to a whole, you know, back in the day it would literally be, or an Apple share certificate. They're like, I don't know, 500, 800, whatever the hell they're at, right? That's like one share. So then to figure out how many shares this buys, I divide 300,000 by 24 cents, and I can see that the investor has 1.25 million. And let's do math. Oh, fun. I'm logged in with something that can't edit this. Is it worthwhile? We need the Alex Trebek music. Thank you, thank you. Oh no, it is there. I just actually scrolled it away. Duh. I don't know why I put it there. So everybody gets diluted because we've issued more shares, meaning that there's now more shares. So people have the same share amount, right? They still have 2 million like they had up here. This founder 3 still has 1 million, but because we've sold a bunch of shares, which equals 20%, and we have more shares, it means their percentage was diluted. I own less of the company. Is that a good or a bad thing to be diluted? What does it depend on?
Depends if the value of the stock is up.
Right. So the answer was it depends on whether the value of the stock goes up or not. Typically, unless you're doing a down round, then your value goes up, so you get diluted, but your stake is actually worth more, right? You have a smaller piece of a bigger pot. I have another example in here as well. You can walk through this to see what that might look at. I walked through another one where, again, we've increased in value, we've taken in some more money, we're again diluting, and just walk through with another investor and things like that. You can, this is available, you can make a copy and then edit it yourself. So under File, Make Copy, and kind of just play with that a little bit.
Just have a question.
Yes.
So the movie Social Network, you know, at the end, Eduardo was where the fictional
Actually, that brings up a good thing. So, you've got a number of documents and structures around the company. You've got shares, which indicate ownership. How many shares do you have to own to have control over a company? No, common misunderstanding. It actually only indicates ownership. It has nothing to do with control. They're connected, but in a different way. Your shareholders agreement talks about a couple of things, including control and board of directors. Again, in the simplistic format, usually you and the founders are just going to be the board of directors and you're just going to make agreements on stuff and other things like that. But you will also write in your shareholders agreement, along with your reverse vesting, you're also going to say things about how you vote, how control is split up. So a super majority of 66% is something that is fairly typical. You can make these numbers whatever you want for a lot of things. And then again, in our scenario here, founder 1 and founder 2 have 64, so they don't have quite enough to make decisions on their own, right? So they need one of the others to do this major thing, right? The investor they brought in might not have a board seat, so they can meet certain board things. So in that case, there was a shareholders agreement or another document where the people who own the majority reduced the other guy's share because he didn't have control. And there's various things to write in there. Again, don't break your heads around this too much. You're going to start, I'm working with a lawyer in town, Gal. I actually have a sample shareholders agreement from him that I'll see about putting online as well. You want the usual. You want the keep it simple version. And mainly the legal document is there for you and your co-founders to have the discussion up front. Right? I don't worry too much about it, because we can't tell the future. We can hardly tell what's going to happen in the next 6 months with our company, right? But it handles the big stuff. What if someone offers to buy some stock or buy the company, or we leave, or other stuff like that, those basics. And then over time, the board and owners of the company can make all sorts of other decisions to bake into the future direction of the company. Does that make sense?
Just a quick question, that 1.25 million shares from the investor,
Yeah.
that's coming out of the share validated shares?
We're authorized, right? So we have additional authorized, we're issuing new ones,
Yeah,
and this person is buying them.
but it's coming out of that pool.
It is coming in. It's not a pool, it's just been authorized.
Okay.
In the scenario that was mentioned earlier, where like 100K was like given back,
Yeah.
that would indeed be a pool that you could do something with. In this case, it's already authorized but not issued,
Okay.
and as well as the financing, they would issue it and then buy it.
Okay.
Okay? People's heads pulsating a little bit. Remember, this is the simple version that I was showing you. Please.
The three initial founders have 27%. And then the new investor comes in and pays his capital contribution, and he gets 20% of the entire company.
Yes.
Why is his 20% not coming out of the leftover 5 million authorized shares?
So that was the question that was just there. They're authorized but not issued. So there's only 5 million shares in existence. Remember, think of shares as they are the thing that you like buy and sell, right? So there are actual 5 million issued, and there's the founder split, right? And to take the investment in, to sell the investor shares, we issue exactly that amount and sell it to them. So there's no extra floating around at that point. They've just been pre-authorized that says, without asking anyone, without doing a board vote, we can go ahead and issue is the official phrase, those new shares.
Sometimes companies also ask for the current people to take some shares.
There's all sorts of different scenarios. If you, for some reason, don't want to issue new shares, you might have some of the existing people not give.
No, you do it, so.
In some cases, sell. So I know that Hootsuite had, I don't know the details, but I believe Hootsuite is part of their financing. Some of the original owners and founders also sold
Yeah, I was one of them.
some of their shares. There you go. Yeah, so that's, you're not giving them back, you're having the opportunity to sell them.
Yeah.
So that might have been another scenario. They could have actually sold their existing shares, and it would have equaled out to the same thing. To, you know, the share price would have been different because of the number of shares outstanding and some other things like that.
So why do you need the extra 5 million authorized shares?
It saves a step down the line that you don't have to go through the process of doing the authorization step.
Guess we'll see in the next few slides.
So one other question for you, which was, you mentioned that in terms of owning control, it's 2/3. So is it based on 2/3 of total shares, or is it based on? Because I know there's also board seats, and a lot of investors want.
So written into your shareholders agreement, there will be certain things, certain rights that the board has, and certain decisions that needs board approval. There's other things that shareholders, some percentage of shareholders overall need to make decisions on, right? Tends to be the bigger things. So you're right, there's board level control and there's overall shareholder control. And that's all encoded in your shareholders agreement.
And is there typically a difference between, like, how would you categorize something as being something the board decides on versus?
It's literally something that you decide which are important to put in to a vote to everyone, and it's just to the board, which tends to be a little closer out. I've done a simplistic version where there's only one investor putting in $300K. Imagine 10 investors putting in $30K.
Right.
That you don't necessarily want to walk around and get a signature from all of them. I'll give you an example. So that is the same type of thing, but might have different thresholds, right? So you might need board approval to take a loan of $100,000 or more. But you might need major shareholder approval to take a loan of $500,000 or more, right? So that's one example where it's both the same thing. Typically, the board is the one who sets compensation for founders and employees, right? Over time, major, right? So the executive team. Does that make sense? You have a question back?
So then what do companies typically do then for electing, like, as a founder, what would you typically do in terms of, I guess, choosing who's on your board?
Keep it in-house until someone forces you to give up the board seat. Why would you do anything else? It's control is a negotiation, right?
So you're saying that you as a founder would be a member of the board?
Usually it's the founders that are the board until such time as you have other people coming in.
Right.
There's good reason to have advisors and mentors
Right.
that you're going to ask for help and support and not make decisions without anyway, right? But you don't necessarily need to complicate it right at the beginning with the board. There's a lot of discussion on startup boards. I think Brad Feld is actually coming out with a book about this, and that typically tends to be in later rounds of financing. It's required as part of writing the check. It's like the negotiation. We want this percentage, and we want a board seat, or we want a board seat and the ability to nominate one independent director. Those sorts of things.
Okay, thank you.
Yes, in terms of incorporating an actual company and whatnot, right? So say, for example, you have that filled out, where would you actually bring it to? Is there like resources around that you can really see that you can?
So you can, the simple part of it, incorporation, you can just do online. If you're going to set up a formal structure with a shareholders agreement and reverse vesting and so on, you go to a lawyer.
Okay, gotcha. So if it's just a simplistic incorporation, you go through like, whatever, like,
So there's an online portal, right? You can do yourself the incorporation part. All of the other things around stock and other things like that, you're signing formal legal documents and you're not a professional, so get a lawyer, right? It does cost a stack of money, right? But it's gonna cost you even more if you don't have stuff like reverse vesting written down, right? And most lawyers, I have a list of lawyers, tend to have certain packages for startups that kind of give you everything you need all in one, right? But you should still sort of budget for year one, minus any sort of financing, figure about 10,000 in the door, and 6,000 to 8,000 in accounting, roughly. Another question over here.
So for a private company, which information is like public or like private from all this?
It is all private.
Okay.
So if someone is proposing to invest in your company, one of the documents that they're going to want to see is the cap table, right? I tend to just ask people, and then they just tell me. You know, I don't feel super sensitive to it. There's not a lot to hide, and it tells a lot about the formation of the company, who the founders are, and other stuff like that, right? So, but yeah, the like official name of the company and your incorporation and like whatever address you have for your lawyer and what your business address is public, and all this stuff is technically private. You're not gonna, you know, Google this or find a portal that has this listed. Any other questions right now? This is the more complicated version that has a bunch of math going through it and goes through multiple rounds, C1, C2, and then you kind of trace through what happens. And a summary, so you can see it more simply, and what's evaluation and so on. Ed Levinson, who's a local investor, put this together. And again, these are the kinds of things that you kind of, this may seem hard and scary in math and so on. Get in and play with the numbers a little bit, and that's what will make you feel comfortable with it. I promise you, it's no more complicated than coding, except that it involves humans, which means there's no right answer. So, I actually have an updated version that goes into a little more details on Medium. These are my rough buckets of what funding looks like. A C1 round is sort of 3 to 500K, and my expectation at that point is that you've got working code and customers. In part, this de-risks it for the investor. They know that you can ship, and they know you can sell. Before having done those two things, if you haven't done it before, I don't know that you can do that. So what do you do before that? That's where, like, working on stuff nights and weekends, friends and family. Even if you're doing a friends and family investment, you want to do it properly. That, you know, oh, grandma gave me 50K and I didn't really write it down anywhere. It's like, you accidentally valued your company at $10 million. Oops. Go explain that to grandma. I say 30K prototype because I try and be prescriptive. You shouldn't be outsourcing a giant chunk of your company with a giant amount of dollars, right? About 30K is the max that I feel comfortable with someone doing a prototype around. Co-founders, right? Obviously, if you're a single founder and be like, oh, I really need a business guy to help me sell this, then you can pay them in equity, right? Accelerators, how many of you have heard of Futurepreneur? Right, handful. So local, across Canada, there's a program for people under 40. I turned 40 on Sunday, so I've got like 3 more days I could apply. Yeah, that's their definition of youth. makes me feel awesome. So it's in the form of a loan. They typically have been funding small businesses, but increasingly, a lot of those businesses are digital businesses as well. Good crew here locally. Consulting, right? I mean, it's hard, but in tandem, if you're working on a particular problem space, you may do, custom code or one-off stuff for certain clients, as well as you working on your product. Dangerous path. It's hard to do product and consulting at the same time, but you get to own your whole company.
You also have to hustle a lot to get sales.
Which you need to do
Yeah.
for product as well. So.
I'm just saying it's hard.
Yeah, it's hard and takes time, right? C2, there's this other chunk of time where you've been in the market, and clearly you've got a product that's selling. At this point, you actually have people paying you for it. I say or significant traction. If you have some sort of freemium model and it looks like people are going to convert and everyone's like, oh my god, this is amazing, I love it, and you have the signups and stats to prove it, that can justify another round of funding. These are also scoped to B2B businesses, right, where you're selling usually a monthly service to other businesses. B2C is incredibly hard. So most business to consumer models that I see have models that are like, step 1, get 1 million users, step 2, profit, right? Except it turns out the step 1 of getting 1 million users is incredibly difficult. And you're not going to get there without cash and time. So B2C models, really, really hard. You're unlikely to succeed with a B2C model. So how do you test the B2C model to show traction ahead of time? You might get funding for it. A lot of these things have been shifting over time. This whole area used to just be friends and family, and then you get $1 million, right? There's a lot more graduation along the way. Accelerators, I have those up there as this pre-series. They don't really handle a lot of money at the end of the day, but you usually go to an accelerator in part to help you raise your first or second seed round, right? So you really need to have something up and running already at that point. Don't enter into an accelerator and be like, right, better turn these PowerPoints into an app.
I actually looked into it. It seems like it's, as you mentioned, it's in terms of a loan, but it's also a loan to the individual, not so much to the company.
Yes.
What are your thoughts on sort of doing that versus getting a loan on behalf of the company? Because
You're not going to get a loan on behalf of the company because you have no assets. So you're just not going to get a loan on behalf of the company.
Is that a good idea to go and get a loan?
Well, if you like personal bankruptcy, this is one of those it depends. You need to be damn sure that you can pay it back, and have a path towards spending it. The results in that, right? There might even be something interesting if you have some early results that shows that you can buy customers through some sort of lead gen.
Right.
Something like taking a loan that you can dump into some recurring revenue would be actually really smart, right? But I would not want to be like, sweet, I'll take this $30K and then code for 3 months. Because that's not sales yet, right? That actually brings me up to something interesting. Again, thinking about the difference between the company and the founders, right? You will have a hard time differentiating between the two. The best model really is to shift a lot of your expenses to the company. Right? Have the company pay for your cell phone, have your company pay for team lunches, right? Anything that you're spending, have the company, I know it's still you and you may actually be loaning the company money to do that, but you running out your personal runway of savings is not the smartest thing. As founders and entrepreneurs, the reason that people invest is because they can't do what you do, right? So that's just something to think about, thinking about okay, I'm good and I have a personal runway of 12 months. It's like, well, instead of waiting for 12 months, the stuff that you have in your bank account isn't the most valuable. It's the product skills that you have to build something and finding a good matching investor that's like, right, this makes sense. Let's have you focus on this. Right? You still want to pretty much, you want to be very aware of what your personal needs are. in terms of cash to put food on the table and a roof over your head, my rule of thumb for an individual without many dependents is like $4K per founder per month, right? That's not me, an investor, saying you should only take that much out of the company. It's just saying, if you're thinking about it, you know, that is kind of the stuff that investors would be looking at. They wouldn't be like, why are you paying yourself $150,000 a year? Don't you believe the equity in your company will be worth something? Does that make sense?
So to clarify, you're saying that if you have like savings of whatever in your bank account, that you should incorporate, put that money into the.
Don't put it into the company, just that's your personal money. Any money you put into the company, keep track of it. It's the company that owes you money for working on it. Right? So don't be like, oh, the company doesn't need to pay me, right? You might even do something like, okay, if the company has no money, right, that I will loan the company money on paper to say you owe me $4K per month that I was working on.
Yeah. So you think that's, like, what's the recommendation?
It's called a shareholder's loan. So, like, just meaning any money or anything that you put into the company is a separate entity from you yourself as an individual. You want to flow a bunch of the expenses through, right? Like, oh, the company doesn't have money, so I'll pay for my cell phone bill. Keep track of it as if the company is paying for it.
Oh, okay. You mean that before you incorporate?
You can only do it after you incorporate.
Okay, I see what you mean.
Question.
Yes?
So when incorporating, would you recommend the initial amount, the capital amount? Would you recommend having it as share capital, or would you recommend it as a shareholder?
So typically, like I said before, my example, you like pay $15 for your shares. So technically, that's $15 in the company bank account, and I just keep those minimal amounts, and then keep track of any other. Once you've decided, like, okay, we're going to found this company, and we're going to put stuff in. I'm going to work on it full time. You're going to work on it half time, and I'm going to put in $50,000. Treat the money separately as a separate thing. It might be a shareholder's loan, or it might be literally buying equity. You don't necessarily need to do it as a sale, but understand, like, okay, we're going to split it 33, 33, 33, and then this other person can put 50K in, like work on it and put 50K in. So money kind of has its own rules, so you should keep track of that, right? Could be a loan, or you could actually be buying additional shares. So this third money bags person might have more shares, and that'd be a way that they could have more ownership. Does that make sense? Yeah. Okay. This is the thing. Try and make sure that you've got you want to work with an accountant on some of these things as well. Again, more about get set up properly. My friend Mike, sproutaccounting.ca, I recommend him for all my early stage companies. As a founder, you probably don't love accounting. So it's one of the things that I try and outsource right away. Holy shit, this is a whole other presentation. I'm not going to dive into this. What we've talked about is common share equity, right? So you can agree on some sort of valuation. An investor is buying the same sort of shares, common shares, that you as founders have. So any decisions that get made, again, control or other things like that, apply to the same class. The investor will be on the sort of same team as you for anything that comes to those sorts of things. How many people have heard the term convertible note? Handful. So basically, someone goes, shit, I really want to invest in your company, but you haven't launched yet. Or you're about to do a deal with Facebook in 4 months from now. It's not signed yet, but we're pretty sure it's going to go through. Well, today, you're basically worth nothing. But in 4 months plus 1 day after Facebook has sent you 200 million users, you're worth a lot. How do we do that? So one of those ways is by basically loaning the company money in a particular format that says, okay, in the future, we can convert into equity under certain terms. And I made you aware of it. We're not going to dive deep into it. It's just another mechanism. You've heard of Y Combinator. They have a document called the SAFE that instead of doing it as a loan, is, again, more of a future promise for equity. Saying, we know you're working on stuff and you're going to be worth a lot. We can't agree what you're going to be valued at, but we're going to put some money in today to actually help you get there. Aside from common shares, so one of the things, here's something to look out for. If you ever walk into a company, let's say you're being asked to join it or something like that, and it's got a share structure that has Class A, Class B, Class C, Class D, all these different share classes, and it's like not a very complicated company, it is one method that accountants sometimes use to take dividends out of small businesses. If you intend to be an investable company, all that shit is going to have to be deleted and redone. So that's just something to be aware of. Typically, you just want to start with common shares and then see where things go from there. You will have accountants and small business lawyers who will recommend, or their template will be like a bazillion classes of shares. If you think you're going to be an investable company, don't do it. Pref shares, preferential shares, you will typically see this these days from institutional investors, whether that's a CVC or a traditional Series A VC. They tend to have things like board seats. They might have a different type of control written in that's tied to the ownership of these preference shares as well. There's a funky stuff about liquidation preferences. Basically, all this means is that if you sell the company, these preference shares get paid out first. And that's part of the sort of math of a VC investor. On a scale of 1 to 10, how confusing is this page? 5? Only a 5? Questions? Thoughts?
So at what point would you start issuing preferred shares? When you start having seed investors?
As I've said, institutional investors, such as a CVC. Again, this is a negotiating thing where someone will want to, ideally the investor will issue you a term sheet that says, we would like pref shares at this valuation with this set of control and this many board seats, right? And that's where your negotiation is. You, most of the time, out of your own free will, don't necessarily want to do pref shares.
So when you say a negotiation tactic, can you give an example?
I mean that most VC term sheets will require preferential shares, and they won't budge on that. Right, so some of these other numbers, right, so a liquidation pref, so these days it's 1x, so meaning that the investors get their money out and then some before anyone else gets a piece, so that's part of the tactic. Again, there's a bunch of good stuff. Brad Feld, Startup Deals, I think it's called, that if you are actually sitting down for venture financing, you should read. This is the crazy slide where the top of everyone's head blows off even more. So imagine there's one company. It's set up, it does a 300K seed round of just common equity. It's going to be 25% dilution, which means that your pre-money value will be 900K and the post will be 1.2, right? That's simple. We said it was worth 900 and we put 300 in, so therefore it's worth that much. And how do we come up with that number? Well, 25K per month per earner times 12 months, right? And with my 4K number, that might be 5 people, 5 early employees / founder people that agree to work for $4K plus $5K a month in expenses gives you a year, right? So if you ever wonder, so if someone says like, oh yeah, I often ask like, oh, how many people do you have on your team? And they'll say 5 or 6, right? Oh, how many people do you want to hire in the next raise? And they say 1 to 3. Then I'm like, oh, so you're raising $800K. Because math, right? You want to raise enough for like a year. In a C2 round, we do a convertible note. We have a higher burn, doubled our expenses, so we're taking slightly more than that. There's no dilution because it's just a future promise of conversion, right? We don't know what the shares look like at this point. Then we do a 1.5 million Series A. Again, our burn has gone up with our 25% dilution target. All of a sudden, holy crap, we're worth almost $8 million at this point. So this might be a not atypical way of going. And these are kind of Vancouver or Canada numbers. Sometimes in the valley, this number goes here, 40 to here. Definitely burn rate higher, but just way more investors, right? Many more investors and many less risk-averse investors who care about getting into a deal early. And like in some ways, this, and this is a fucking waste of time. All of this prevents you from working on product and selling to customers. Right? Any questions about this crazy slide? Again, these are just made up numbers, but like they're in the realm of possibility of how some of these numbers work. You don't raise money and then figure out what to do with it. You figure out what your expenses are going to be for a year and go, okay, well that's how much I need to go heads down and work on product. And I think I can add these 3 features and sales dues and add 50 customers bottom up, right? Not projections, not like, oh, we're going to win 1% of the global real estate market. How the hell are you going to sell individual customers month by month? Right? Guys, your brains are full, so we're done. Slides are up there already. I haven't really modified them. I'd love feedback on, I know there's lots of confusing pieces in here, especially if this is the first time that you've engaged with it. The slides are fairly full of stuff. Happy to answer questions if you tweet them at me or other things like that. Tools page has a ton of different things in it. The links to the Excel spreadsheets are there. I worked with Lavarge in the past, and there's another presentation that goes into this. This captable.io is a tool that I currently recommend that you can actually keep online and share with your lawyer and stuff like that. We built a little tool that basically is a wizard that you walk through. And at the end, it's you auth with your Google account, and it dumps an Excel spreadsheet with the numbers that you filled out that show you sort of this SaaS user model. You're spending on advertising and other things like that, and putting in who, what, where, and when you're hiring, and what that is. I have, there's a deck on that same spot that kind of covers this that I gave out at UBC. Very roughly, at the very least, these 4 things are the things that you're going to be asked for. I say investment deck rather than pitch. Again, there's a link about this on the Full Stack Tools page. PowerPoints aren't special things. They shouldn't be marketing-y. They're literally the, like, here's the succinct plan of my company that I want to share with you and have a discussion about. You do need to have this proceeds. It will be wrong in 6 months, that's fine. You do need a user model that shows, are you going to sell $5,000 enterprise customers or $50 a month self-sign-up, because that affects your hiring and everything else. And then the cap table. So if you're going to go down the venture path, people are going to want to know, what are you going to do at the end of 12 months? Whatever the period is. Now it's really over. That was just the backup. Anything else?
Can you go back to the previous? A bit more? Okay, that's it. Thank you.
All right.
Thank you. You mentioned during the talk, you had a list of resources somewhere, including lawyers. Just that.
All on that full stack tools page has all those bits.
As well, we'll try and make all of this available later for everybody that's attended it. So if everybody just wants to, they can come back to CodeCore, they can check out codecore.ca, events.codecore.ca for the future events. So we'll try and get everything for Boris up there so it's available. And of course, Boris is available to speak with right now, you know, he's a consultant as well. So, and then if anybody's interested in, you know, the boot camp or speaking with town about future events, we will be having a speed interviewing event on March 6th. So if you guys are from a company that will be hiring developers, we would love to have you come and do the speed interviewing event where we'll have a bunch of developers. And this way, your company can get to know many people at one time and then just have something to simmer on for the next, 6 months or a year, right? So another great thank you. Lead instructor and the owner here at CodeCore. So
Well, just thanks a lot for it. It was really informative and I've learned a lot from it.
Good, awesome. Thanks, guys.